IBM stock crashed 25%, and everyone wants to know what this means. Is this a buy the dip opportunity? Or will the dip keep on dipping? Or more broadly, is the AI trade itself over? If AI is booming, why did this happen? IBM, of course, has a real AI platform, Watson X, for training and deploying machine learning models and generative AI models. They also have Granite models, AI agents built for autonomous enterprise operations. This is not some legacy company simply bolting on an AI strategy for investors. And despite all of that, the stock just got crushed. 25% in a single day. $670 billion of market cap gone, over a revenue miss of roughly $660 million. Do the math on that for a second. That's roughly 100 to 1 reaction. $100 of market cap value wiped away for every $1 of revenue miss. That's pretty massive. If your first instinct is the AI trade is over, I don't really think that's what's actually happening here. I think IBM's earnings just revealed something more specific and more important for you to know and to think about for your portfolio going forward. I believe the AI trade is entering in a new phase. It is no longer enough to simply be a tech company with some AI offerings. The winners are getting a lot more selective, and IBM itself just became the case study. But first, welcome back to the Lunch Money Investing channel, where an ex-math econ nerd focuses on 1 to 2 market-moving items each week and breaks them down for you so that you can make more informed decisions for your portfolio and, of course, protect your lunch money. If that kind of content sounds appealing to you, please consider subscribing. I like to go beyond the headlines here. So if you're interested in that, subscribe to the channel and tune in. Okay, enough of that. Let's get into the main story for the day. First, the facts, because you need to understand these before anything else makes sense. IBM pre-released results ahead of their official quarterly report, which is scheduled to come out later the week of July 20th. Companies rarely do this. They only do this when something serious enough happens and they simply cannot wait. And that's pretty much what happened. It was very rough, to say the least. Revenue growth guidance got cut from 5% projected in April, just 3 months ago, down to 1%. Infrastructure revenue was down 7%, while GAAP earnings were down only 2%. Here's the part that actually explains the violence of the reaction. Normally, if a company is going to miss, you see it built early in the quarter. And then, if it gets better, they simply say, hey, it got better during the call. Instead, IBM said the exact opposite. They started the quarter off with weak expectations to begin with. And then the results, real life, hit hard in the wrong direction. They were caught off guard by their own internal numbers. That's why they felt they needed to come out and warn the market before the actual report happened. There's also some legal reasons behind all this, but that's beside the point. Now, here's a detail almost nobody's going to talk about, and it's the detail that matters most for the thesis of this video. IBM's software segment held up relatively fine, with one exception, and we'll get into that later. It's also worth noting that in previous cycles, this crash of IBM would have brought down the broader tech and software space. However, we didn't see that happen this time. Some stocks like Workday fell in sympathy, but then recovered before the end of the day and were close down maybe 2 to 3% from as low as 8%, right? That's the first clue into this story. This isn't a story about IBM itself being broken. It's a story about which part of IBM is broken and, more importantly, why. Now here's where it gets interesting, because not too long ago, in the same AI economy, 2 other companies just posted some of their best numbers in history. If you think back just not too long ago, Dell reported Q1 results on May 28th. I know it's a while ago, but bear with me here. Record revenue of $43.8 billion, up 88% year over year. Record diluted earnings per share of $5.24, up 282%, and record cash flow from operations. Dell wasn't alone. On June 24th, Micron Technology reported Q3 2026 earnings, fueled, in their words, by historic demand for memory chips. Revenue there quadrupled year over year to $41.46 billion, crushing analyst estimates. Adjusted earnings per share came in at $25.11 versus what the street expected of $20.78. Data center revenue alone surged more than 7-fold. That's an insane amount. to $11.5 billion. And they didn't just have a good quarter. They locked in 16 long-term customer agreements worth $22 billion in future commitments. Sit with that contrast for a second. If the AI trade were indeed slowing down, cooling off, running out of steam, you would not see this type of action. You would not see Dell and Micron posting their best quarters in corporate history in the exact same quarter that IBM had to come out with a warning to investors. Granted, I understand there's a 1-2 month lag time, but IBM came out because of what they were seeing earlier in the month, not because of what's just happening today, right? So the AI boom itself is not fading. Instead, it's concentrating. It's flowing hard into the physical infrastructure layer, the chips, the servers, the memory, the storage, and leaving everything else behind. Even genuine AI platforms like IBM's own Watson X and Granite models are not enough to attract IT capital and investor capital. If AI is not the core of what the company does, then it's not enough to attract capital at scale. Being tech, being AI adjacent, that used to be enough to get pulled up along. That is not the case anymore. Things are changing. So why is this specifically happening to IBM right now? IBM's own vice chairman, Gary Cohn, gave us a pretty direct answer. He said the capex pause that hit them was driven by a handful of large deals that simply got paused near the end of the quarter, not something that impacted broadly their whole business. He specifically called out mainframe and mainframe adjacent software as where the pain was concentrated. That's where they saw the biggest pain point. Here's the mechanism underneath all that. Corporate IT budgets are not unlimited. They're a fixed pie. And right now, hardware costs are rising because supply is tight. Memory, servers, storage are all supply constrained. So when a company has to choose between locking in scarce supply constrained hardware and continuing to fund a legacy software or legacy mainframe contract, the hardware wins right now, every single time. On top of that, corporate IT budgets are getting squeezed as token costs have been exploding. As an example, Uber burned through an entire annual budget of tokens in just 4 months. And there's one more comment from Cohn that I think is the most underrated data point in this whole story. And it's more about the tokens, right? He talked about companies starting to question the actual return on their AI token spend, basically asking themselves, are we getting our money's worth from all this generative AI spend? Or did we overspend? And there's a real possibility here. Some of these companies paused their human workforce reductions, and some are even rehiring and realizing you can't simply replace people with AI models at a broad scale. So right now we're in the middle of what I believe is a right-sizing phase across corporate America. And that right-sizing phase is going to keep shaping demand for products like IBM for a while. So I think what we saw in this most recent quarter could balance itself out over the next year. But anyways, putting it all together, here's the main plot. It is no longer enough to simply be a tech company or even to have real AI products. If you are not sitting directly inside the physical AI infrastructure layer build out or primarily focus on the AI model layer, then you're going to get crowded out. And as I always like to say, stocks are not necessarily traded exclusively on their fundamentals. They're traded on their stories. And right now, IBM is having a bit of a story problem. But I think this chapter will pass and we'll see something bigger and better in the future. Okay, so we covered the fundamentals of IBM and what happened on the business side that drove or could possibly explain this reaction. But I want to take a look at the charts because I believe the charts have their own story, their own version of what's happening, right? So looking at the charts, IBM ran from 225 on May 20th all the way up to 332 on June 2nd. That's a 47-48% move in the span of 8 trading days. That's enormous. I know we're used to big moves around here, but for a company the size of IBM, that's a lot, right? So then you might ask yourself, what happened on May 20th? And I'll tell you. An old post by Donald Trump about the company, about IBM, started trending hard and the stock just took off. All this positive sentiment because of this trending story from one of Donald Trump's old posts. And here's the thing people are missing. Before the Trump pump even started, IBM was already rolling over from a previous high of $315 down to around $225 before the stock went wild. Basically, in my mind, the uptrend was already cracking. So when I look at this 25% crash, here's the broader picture that I see. I don't see it simply crashing out of nowhere because of bad news. It didn't create a discount out of nowhere. It removed the hype that had built up that was completely disconnected from the company's fundamentals from reality. It was pricing out the Donald Trump hype, in my mind, right? The stock got ahead itself on a political tailwind, and then the business came back down to reality hard, and that's the 25% crash. So now, what everyone came here for, is this a buy the dip opportunity? Here's my honest take on that. I don't think IBM's business is fundamentally broken. I think instead the growth assumptions that were built into the stock were simply too ambitious. And this market correction is simply a re-rating of those underlying assumptions, bringing it back down to reality and also taking out some of the hype. That's a very different problem than the company itself is in trouble. Personally, I'm watching to start buying around $195 a share. And I want to be very upfront. I fully expect the possibility of another 10, 20, or even 30% downside from there, especially if guidance keeps deteriorating from here going forward. My crystal ball, unfortunately, is broken. And if you have one that works, hit me up. So I can't tell you exactly how IBM's business will perform from here or exactly what the next guidance is going to look like. But in my mind, right now, what we're seeing is corporate budgets right size. And I think over the next year, as companies find a balance between their token spend, between their infrastructure spend, I think overall, IBM will be able to recapture some of that spending. But here's the bigger takeaway I want to leave you with, because it's bigger than just IBM. Watch for this pattern exactly going forward into the earnings season. Companies that talk about AI, companies that have AI branding, and even companies that have real AI offerings, if they don't have direct exposure to the physical infrastructure layer or the model layer, they may be facing the same squeeze. This IBM story just might be the first case of this trend that plays out across a lot more of the tech sector over the next few quarters. Sometimes a stock doesn't crash because the business is broken. It crashes because expectations were made that the business couldn't deliver on, or simply investors got ahead of themselves, right? Anyways, quick update on my M1 Finance portfolio. It's actually hit a milestone that's pretty big, at least to me, right? It's at $3,000 now. Obviously, still very, very far from the $1 million goal, but it's a start. So we are, 0.3% of the way there? Better than nothing, right? Anyways, most of the gains, not most, all of the gains have been from my contributions. I contribute 20 to 30 bucks every single day, going in, shoveling money. The market performance itself is actually negative, down 60, 70 bucks. It's only gotten from 2 to 3,000 because I've put in 1,000 and change, right? The biggest winners, looking at the overall portfolio is down, but there's some winners in there, have been the leveraged equities positions. So SSO, QLD, and UPRO, those are all up, and those represent about 35% of my portfolio. The biggest losers have been crypto. And I actually made a video about that not too long ago. Crypto has been tanking. It's trading around $65,000 a coin. And that has really been a drag. That itself has overwhelmed the gains made from the equity positions. But I'm still buying, right? I'm not hiding from that leverage. I'm not hiding from that Bitcoin exposure. I'm leaning into it and have actually increased my overall allocation to cryptocurrencies. So not just Bitcoin, Ethereum as well. Anyways, to close off the video and recap the whole thesis of this video in one line, IBM's earnings just released that the AI trade is entering a new phase. The boom isn't lifting every tech company anymore, at least not equally. The winners are getting a lot more selective. And whether IBM ends up being a great buying opportunity from here or a value trap depends entirely on which side of the line they end up. I'm tracking this shift as part of my own portfolio journey toward $1 million, stock by stock, in real time, not just reporting the news after the fact. If you want to follow along, please consider subscribing to the channel. And if you enjoyed this video, smash that like button. It means the world to me. It means the world to my boss, the algorithm. Anyways, I'll see you on the next one. And as always, protect your lunch money.